Okay, let's dive in. You know that feeling, right? That kind of knot in your stomach when you think about money. It affects us all every day.
It really does.
But what if getting good with money wasn't about being some kind of math whiz? What if it's more about, well, behavior?
That's exactly the core idea we're exploring today, drawing a lot from the psychology of money and some related insights. It argues pretty convincingly that how you act is way more important than how much you know.
So forget the super complex formulas for a second. We're going to unpack the sort of hidden psychological stuff that shapes your financial life.
And what's really striking is how much our personal experiences dominate our financial worldview. You'd think there are universal rules, but we all see them through such different lenses.
Lenses shaped by our past. Right?
Precisely. Where you grew up, when you grew up, the economic climate. It all creates this unique perspective, sometimes leading to decisions that look, well, frankly, bizarre from the outside.
Yeah, get this. Imagine someone who grew up during, say, really high inflation versus someone who only saw stable prices.
Totally different perspectives on debt, on saving, on risk.
Or someone whose parents struggled through a recession versus someone whose family maybe did really well during a boom.
Their whole financial playbook is different, not because one's smarter, but because their foundational experiences, their sort of financial childhood, was completely different.
Think about a stockbroker who lived through the dot-com crash versus like a tech worker who only started investing in the last 10 years.
Vastly different views on risk and bubbles, right?
Yeah.
The book highlights this idea that our personal experience, which is like, what, 0.0000001% of world financial history?
Tiny.
Yeah, tiny. But it accounts for maybe 80% of how we think the world works financially.
And there's actual research on this, isn't there? Malmendier and Nagel.
That's right. They showed that investors' risk tolerance is measurably linked to the stock market and inflation experiences they had during their own lives. It's like those early experiences get hardwired.
Wow, so it's not just feelings, it's quantifiable.
It seems so. And even the pros acknowledge it. Bill Gross, the bond king, he admitted that a huge part of his success was just the fact that interest rates fell for basically his entire career.
So his experience was bonds, amazing wealth builders.
Exactly. But someone experiencing decades of rising rates and inflation would see bonds as, well, wealth incinerators. Same asset, totally different reality based on timing.
It really hammers home how varied economic reality can be, even within the same country at the same time, like the 2009 crisis.
Oh, absolutely. Unemployment hit different groups so differently.
Yep.
Someone in a sector with 5% unemployment had a radically different experience than someone facing, say, 25% unemployment. It wasn't one single economy for everyone.
So the big takeaway here is maybe empathy. Understanding that every decision, however irrational it looks to us,
Makes perfect sense to the person making it, given their unique story and view of the world.
the book uses the lottery for example, right? Low-income folks buying tickets seems illogical if you're well off.
But if your options feel really limited, that ticket isn't just a gamble on numbers. It's buying hope. It's paying for a dream, a tiny chance at a completely different life you can't otherwise access.
That reframes it completely. It's like the book says, what you're doing seems crazy, but I kind of understand why you're doing it.
That's such a powerful idea. It unlocks so much. Because finance isn't done in a spreadsheet in a vacuum. It's social. It's emotional. Ego, pride, marketing, history. It's all in the mix.
Which leads right into this whole luck versus skill thing. It's so hard to untangle.
It really is. The book looks at figures like Bill Gates and Cornelius Vanderbilt, both massively successful. But wow, different paths and contexts.
Vanderbilt was pretty ruthless, wasn't he? Kind of pushed the boundaries of legality sometimes.
Yeah, and it raises that question. Where's the line between bold genius and reckless gambling? And how much was skill versus just being in the right place, right time with the right disposition?
It's tricky. And then you have Benjamin Graham, the father of value investing.
Right. His biggest win came from JICO, which totally violated his own diversification rules. Was that genius insight or just, incredible luck on one bet?
Almost impossible to say after the fact.
Exactly. Which is why trying to just copy the exact moves of outliers like Buffett or Graham is probably misguided. Luck plays too big a role in those extreme successes.
So what should we focus on then?
The broader patterns. Look at what generally works for most people over time, not the lottery winners. Like the finding that having control over your time consistently links to happiness, that's actionable for almost anyone.
That's a great point. Much more applicable than trying to be the next Warren Buffett. I love that Bill Gates quote the book mentions.
The one about success being a lousy teacher.
Yeah, it seduces smart people into thinking they can't lose. Such a good reminder, especially when things are going well. Acknowledge the luck factor.
And the risk factor. Nothing is ever quite as good or as bad as it seems in the moment. There's always chance involved, both good and bad.
Okay, so personal history, luck, skill. What about this idea of enough? That anecdote with Vonnegut and Heller is fantastic.
Isn't it? It's a billionaire's party. Vonnegut points out the host made more in a day than Heller ever did from Catch-22.
And Heller says,
Yes, but I have something he will never have. Enough. Just brilliant. It cuts right to the core of it. Real wealth isn't just more, more, more.
It really makes you think, especially compared to stories like Rajat Gupta, reached the absolute top, had so much.
And risked it all. Risked what he had and needed for something he didn't have and didn't need.
Which is exactly what Buffett said about long-term capital management, right? That it was foolish to risk the essential for the non-essential.
Precisely. It highlights how crucial and how difficult it is to get the goalpost to stop moving. To actually define your own enough and stick to it.
Because if you don't, you might end up risking things that are truly priceless.
Things like your reputation, your freedom, family, happiness. Those are never worth the gamble, no matter the potential upside. Knowing when you have enough protects those things.
Okay, shifting gears a bit, let's talk compounding. The book uses that ice age analogy.
Yeah, how tiny changes in temperature, sustained over millennia, create massive ice sheets. It's not about huge force, it's about persistence.
Small inputs, huge outputs over time.
Exactly. Compounding is all about time. Extraordinary results don't always need extraordinary actions right now, just decent actions sustained for a really long time.
Like Buffett again. His genius is undeniable, but a huge chunk of his wealth is just time. Starting young and staying invested.
It really is. Contrast him with Jim Simons. Simons actually had higher annual returns on average, incredible returns.
But less overall wealth.
Considerably less, yeah. Because Simons started much later. Buffett had decades more for that compounding magic to work. Time is the most powerful variable.
It's weird how our brains don't naturally grasp exponential growth. We think linearly.
We really do. The book mentions how storage capacity exploded. A gigabyte seemed insane not that long ago, even to someone like Bill Gates early on.
Yeah, shows how easy it is to underestimate compounding. It just creeps up on you, then accelerates like crazy.
But getting those long-term compounding benefits requires something else crucial. Staying in the game.
Getting wealthy versus staying wealthy. That's a key distinction.
Huge. The book contrasts Jesse Livermore and Abraham Germansky in the 1929 crash. Livermore made a fortune shorting the market. Germansky was wiped out.
But Livermore didn't stay wealthy either, did he?
Nope. He eventually lost it all too. Getting rich and staying rich require different skills. Staying rich is more about survival, avoiding ruin.
Survival, like just not getting wiped out during the downturns?
Exactly. Michael Moritz from Sequoia Capital said their focus was always on surviving. The fear of going bust kept them disciplined. Compounding needs years, decades uninterrupted. Like planting an oak tree, you have to protect it while it grows.
So survival means avoiding huge losses. How do you do that?
Well, one counterintuitive tool is cash. Holding some cash isn't just about low returns. It's about having the option not to sell your investments when they're down. That option can be worth far more than the interest you miss out on.
It's insurance against forced selling.
Precisely. Good returns sustained for a very long time will always beat great returns interrupted by disaster. You need a plan that anticipates things going wrong, because they inevitably will. Few plans survive first contact with reality.
Picked up the last 20 years alone. 9/11, the financial crisis, COVID. Nobody perfectly predicted those.
Right, so your plan needs room for error. It needs to work okay, even if reality doesn't match your rosy projections.
Okay, so survival is key. And part of that reality is these tail events, right? Rare stuff with huge impacts.
Yeah, the book really emphasizes this. Think about venture capital. Most investments fizzle out or do okay.
But a tiny few are massive hits. Google, Facebook.
Exactly. Those tails drive almost all the returns for the entire fund. And the stock market works similarly.
Really? For regular stocks, too.
Yeah. Studies show a small fraction of companies generate the vast majority of long-term market gains. Most stocks actually underperform treasury bills over their lifetime. Many just disappear.
Wow. So you need exposure to those potential big winners, but you also need to accept that most individual stocks won't be home runs.
Right. And it applies to investor behavior too. Your results often depend less on daily tinkering and more on how you handle a few key moments like major crashes or euphoric tops. Do you panic? Do you stay disciplined? Those decisions have outsized impact.
It's like that Soros quote again.
It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Nail the big wins, survive the losses. Tail events matter hugely.
Okay, we've covered history, luck, survival, tails. What's the point of all this money stuff? What's the real value?
Great question. The book brings in Angus Campbell's research on happiness. Found something interesting.
Which was?
That having more wealth didn't automatically equal more happiness. The strongest factor. A sense of control over one's life.
Control. Doing what you want, when you want, with who you want.
For as long as you want. That, the book argues, is the highest dividend money pays. Not fancy stuff, but autonomy.
Yeah.
Freedom.
I can relate to that. I once had this high-paying internship, investment banking. Sounds great, right?
On paper, yeah.
But I was miserable. Absolutely no control over my time. Felt completely trapped.
That feeling is powerful. Psychologists call it reactance, this innate desire to resist being controlled. Freedom is a deep human need.
Definitely. Later, I quit a job with just like $12,000 saved up to try being a musician. Terrifying financially.
I bet.
But that feeling of freedom,
Yeah.
taking control, that was the life-changing moment more than any later financial success. It's weird how the U.S. is so rich, yet people report so much stress and worry.
It is a paradox. And when you ask older people what mattered most for a happy life, they almost never say being rich.
What do they say?
Quality friendships, being part of something bigger than themselves,
Mhm.
spending time meaningfully with people they love. Things money can help facilitate maybe, but can't directly buy.
So control over time is the real goal. Which brings us to how we think about wealth itself. The Ferrari example.
Yeah, yes. You see a Ferrari drive by. What do you think?
Usually, wow, if I had that car, people would think I'm cool, successful.
Exactly. You admire the car and project yourself into it. You rarely think, wow, the person driving that car must be admirable. You're focused on your own potential admiration from others.
So we use possessions to signal wealth, but people are mostly just thinking about themselves.
Pretty much. Which leads to the idea that true wealth is what you don't see. It's the money not spent, the car not bought, the upgrade skipped.
Wealth is the option value created by unspent money.
Perfectly put. Bill Mann's quote captures it. Spending lots of money makes you feel rich quickly. But the way to be rich is to spend less than you make. It's the only way. Wealth is the residue of income not spent.
And building that residue, that wealth, isn't just about income or amazing investment returns. It's hugely about...
Your savings rate. Simple as that. How much you save out of what you earn.
That's often more controllable than your income or market returns.
Absolutely. Think of the 70s energy crisis.
Right.
We didn't just find more oil, we got way more efficient. We reduced demand. Saving is like financial efficiency. It's powerful and mostly up to you.
And saving isn't always for a specific goal, like a house or retirement.
Right. Sometimes it's just saving for saving's sake. It's a hedge against life's inevitable surprises.
Yeah.
It buys you flexibility. It buys you that control over time we keep talking about.
Which circles back to behavior. We aren't spreadsheets. We're emotional humans. So financial decisions shouldn't aim for pure rationality, maybe.
The book argues for reasonableness. Aim to be reasonable, not necessarily hyper-rational. We have feelings, biases, regrets.
Like that weird historical medical example, malariotherapy.
Yeah. Giving syphilis patients malaria sounds insane, completely irrational. But it kind of worked sometimes because the high fever killed the syphilis bacteria. Sometimes the unreasonable path has unexpected benefits, especially when dealing with complex systems like human bodies or finances.
So a reasonable financial decision might be one that helps you sleep at night, even if it's not perfectly optimized on paper.
Exactly. Like the author choosing a 50-50 stock bond split. Maybe not mathematically perfect, but it minimized potential future regret, which helped them stick with it. That's reasonable.
Compared to okay, what about using history? We look back at past market returns. How reliable is that?
That's a tricky one. History is crucial for context, for understanding ranges of possibility, for seeing behavioral patterns, but
the future isn't always like the past.
especially in finance and economics, which are driven by innovation and changing human behavior. It's not like geology where the basic rules are constant over eons. The book warns against the historians as prophets fallacy.
Things changed. Think about the 20th century, the Depression, world wars, tech revolutions. They fundamentally altered the landscape. Things happened that have never happened before.
Exactly. Relying too heavily on past averages can leave you unprepared for structural shifts or true black swan events. Things like 401ks changing retirement savings or venture capital changing how innovation is funded. Those make the distant past less relevant in some ways.
Even Benjamin Graham admitted his old methods became less effective as markets got more competitive.
Right. So while "it's different this time" is often a dangerous phrase, sometimes it is different. And those differences are often what matter most. Investing is more like playing poker than physics probabilities, not certainties. You need humility.
And room for error. That seems critical.
Absolutely essential. Margin of safety isn't just conservative, it's what gives you endurance. It lets you survive the unexpected and potentially benefit from those positive tail events.
So plan for lower returns than the historical average, maybe? Build in a buffer?
That's a reasonable approach. Recognize that even things that seem highly probable can fail. And if the consequence of failure is ruin, like with too much leverage, then the potential upside might not be worth the risk, no matter how tempting.
Leverage really is the amplifier of ruin.
It truly is. The book suggests maybe a barbell strategy, be super safe with the core part of your assets needed for survival, and then take calculated risks with a smaller, separate portion. Ensures you stay in the game.
Because staying in the game, having that control over time and options,
Has an infinite return on investment, as the book says. Room for error protects you not just from known risks, but from the completely unforeseen ones too. Plan on the plan, not going according to plan.
one last big psychological piece. We change. Our goals, our desires, they aren't fixed.
The end of history illusion. We tend to think the person we are now is the finished product. We underestimate how much will change in the future.
I've seen that. Friends who chased a specific career goal for years got it and then realized it wasn't what they wanted anymore. The sacrifices weren't worth it to their future self.
Daniel Gilbert's research nails this. People consistently predict they'll change less in the next decade than they actually did in the previous one. We're poor forecasters of our future selves.
And that messes up long-term financial planning, right? You might save aggressively for a goal you later abandon.
Or commit to an extreme strategy like extreme frugality for early retirement that your future self finds unsustainable or regrettable. Balance at every stage seems wiser. Avoid extremes.
And be willing to change course. No sunk costs. If a goal no longer fits who you are, it's okay to let it go.
Absolutely. Adaptability is key because you will adapt, whether you plan to or not.
Okay, so wrapping up. There's a price to pay for investment returns, isn't there? But it's not just fees.
No, the real price is dealing with volatility. Fear, doubt, uncertainty, regret. That's the cost of admission for potential long-term growth. You have to endure the fluctuations.
Trying to get the upside without the downside, like trying to steal the returns.
Yeah, and it usually ends badly.
Yeah.
The book compares volatility to the entry fee at Disneyland. You pay the fee to enjoy the park. If you see the fee, volatility as a fine or a punishment, you'll hate the experience and probably leave too early.
You have to accept the price to get the potential reward. Even great stocks have brutal drawdowns sometimes.
Huge drawdowns. Netflix, Amazon, Monster Beverage, all massive winners long-term, but all spent long periods way down from their previous highs. That's the price. Trying to smooth it out artificially like GE allegedly did often leads to bigger problems later.
So embrace the uncertainty, pay the fee. What about when things go really wrong, like bubbles? Or the opposite, overwhelming pessimism?
Bubbles are tricky because the short-term incentives can seem rational even when the long-term picture is crazy. Momentum chasing works until it doesn't. And pessimism often sounds smarter, more intellectual.
Bad news travels faster, grabs attention more.
Exactly. And pessimism often just extrapolates current negative trends indefinitely, ignoring our capacity for adaptation and innovation. Think of all the "we're running out of oil" predictions.
We adapt, we find alternatives. Progress happens, even if it's slow and messy. Setbacks are often faster and more dramatic, making pessimism feel more urgent.
Right. But optimism, not blind optimism, but a reasonable belief that odds favor improvement over the long haul is the more realistic long-term bet historically. The world breaks, but it also rebuilds, often stronger.
It all comes back to those stories we tell ourselves, doesn't it? The narratives that shape our understanding and our actions.
Absolutely. Humans are storytelling animals. We crave narrative, especially when faced with complexity and uncertainty, like in finance. We want explanations, even if they're oversimplified.
Like that alien observer trying to figure out the economy based just on surface appearances. Gets it totally wrong because he doesn't understand the human stories, the confidence, the fear.
And in a way, That alien is all of us trying to make sense of this incredibly complex system with limited information and our own built-in biases and narratives.
So as we wrap up this deep dive, the big message seems to be pay attention to the psychology, yours and others.
Definitely. Recognize your history shapes you. Understand luck's role. Define your enough. Harness compounding by surviving long-term. Appreciate tail events.
Value time and options above all else. Focus on your savings rate. Aim for reasonable, not rational. Use history cautiously. Build in room for error.
Accept that you'll change. Understand volatility is the price. Balance pessimism with long-term optimism. And be aware of the power of the stories driving decisions.
So, the final thought for you listening, how have your unique life experiences truly shaped the way you think and feel about money? And reflecting on all this, which psychological aspect might be most important for you to explore on your own financial path? Thanks for diving deep with us.